You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, team, welcome back to yet another episode. Young Investors Podcast time once again. Hamish Hodder, my friend down in Melbourne, what's going on?
Hello. Not a lot. I'm going well.
Are you still in lockdown?
No.
Has all that stopped?
No, we're not in lockdown now. Now Sydney's in lockdown, I believe. So how the tables have turned.
Yeah, well, the tables have turned for me. I was supposed to be going to the Gold Coast this weekend.
Oh.
Gosh, darn it. That ain't happening now.
Really? So you can't go anymore? Is that because you had to go through Sydney or?
Well, partially. I was going to try and get my flights changed from Sydney to a direct flight from Canberra. I could have. So Sydney Airport, I think, is still functioning. If we wanted to use Sydney Airport, we had to go in our own private car, and we weren't allowed to get out along the way or something.
Right.
So we couldn't use the Murray's bus, which goes straight from Canberra to Sydney. That wasn't allowed. So it was just a hassle. And Gold Coast went into a three-day lockdown, which was ending on the day that we were supposed to be leaving. So it's like a bit of a gamble. Like, are they going to extend the lockdown? Who knows? So we just decided to can it. Luckily, we actually got refunds for our flights. We didn't get refunds for the bus fare. However, we did get refunds for our Airbnb. And this is actually a little interesting thing which I didn't realize, which maybe it might serve some of you guys in the future. So I'll just mention it. On Airbnb, so you can get like a full refund up until, I don't know what it is, like a couple of weeks before or something like that. But if you go past that time, then the only thing that's refundable to you is like the cleaning fee or the service fee, which is like $25. It was like $25 in my case, really nothing when I spent like $500 on accommodation. However, what I did is I just messaged the owners of the property or the people that host it on Airbnb, and I was just like, hey, look, COVID lockdown, really unfortunate. We had full intentions on coming to Queensland, but now we can't. Is there any way we can get a refund, or is that just, curtains and we've just lost our money? And it turns out for people that host on Airbnb, if you cancel after that time period, after that, full refund time period, then the person that hosts the Airbnb has the option of whether they give you a full refund or not. So even though Airbnb says that you're not going to get a refund, the people that list still say that they still have the final say, I guess. So we just pled our case and then they just gave us a full refund. So there's something interesting. Instead of just cancelling your Airbnb, talk to the hosts and say, is it okay if we get a refund?
Yeah.
Anyway, there's a little top tip of the day for you.
That's really interesting because I guess with a lot of hosts, it would make sense for them. I mean, of course, it would be nice if they could just get the money without you having to stay there. But you're probably likely or maybe in the future going to go and stay at that same place when you're allowed to. So kind of makes sense to lean on the side of giving refunds, I think, when people are just prevented from traveling due to COVID. So very interesting.
And that's what I said. I was just like, look, we still have intentions to come to the Gold Coast. Like, we still want our holiday. It's just not happening this weekend. So, I mean, we're still going to come back and we still want to book in your place. It's just not going to happen this weekend. So I think they were just like, yeah, fair enough. It's better that I just give them the refund and then they'll come back as potentially a return customer at some stage in the future, as opposed to just pissing them off and not giving them a refund. So, yeah.
Is there an airport in Canberra?
Yes. Yeah, we got Canberra Airport. It's actually an international airport now. They did an upgrade to it a couple of years back, I think. So I'm not sure where the flights go. Maybe New Zealand and I think Singapore or somewhere like that. But yeah, I know Singapore Airlines comes to Canberra quite a bit. So
very cool. There you go. Well, we've got a lot to talk about in today's, almost said video, today's podcast.
Yes.
We've got some updates on inflation and some commodities in particular that have had some quite dramatic changes over the past few months. An update on Robinhood, the trading app. some aircraft news, and some updated information around Facebook and what they're doing with Instagram.
Yes.
So with all that said, let's get into today's sponsor so we can get into some of those stories. So today's episode is sponsored by ShareSite, which is an application you can use to track the performance of your stock portfolio. And it will basically allow you to bring in all of your trades automatically or manually from your broker, and track all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So ShareSite generates up to 10 different reports that can be used at tax time to work out things such as your capital gains, dividend income, and more. And at the moment, you can try ShareSite for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. Use that link to sign up to a free plan and use it for as long as possible, as long as you want. Or you can use that link also to sign up to a paid plan for more features and get 4 months off a yearly subscription if you're interested. So go check it out. And thanks to everyone who has used that so far.
Yes, thank you very much. Yeah, very, very helpful. For us here running the podcast. Now, I wanted to get into this first story because what we've seen over the last, I guess, few months is that the price of raw materials has been rising quite dramatically. And, you know, we're seeing people like Warren Buffett talk about that at his annual shareholder meeting, as how Berkshire Hathaway is seeing this massive inflation in the raw materials prices. And he quoted, you know, steel, and he quoted lumber as well for his home building, for Berkshire Hathaway's home building. However, what's happening now with the price of lumber? It seems to be going the other way. Is that right?
Yeah. So it's been very, very up and down, and lumber has kind of been one of the commodities that have moved the most over the past 12 months, up and down. And as a result, it's kind of like one of the biggest examples people point to of the potential of inflation that may then flood into other areas of the market. So the price of lumber, the news story this week, well, actually, before we get into that, I'll kind of preface this with what has happened with lumber over the past 12 months. So over the past 12 months, the price of lumber has gone up massively. So 12 months ago, the price for, and the way they measure this is in 1,000-foot boards. So the price of one of those. So the price 12 months ago was $435 US. And then up until a month ago, it reached a high of $1,670 per 1,000-foot board, which is almost a 4 times increase in the price of lumber over that period. And the way that this price is being calculated is based on the futures market for lumber, which is basically the way that you can trade for trade contracts for buying lumber. And this huge amount of inflation in the price of lumber was driven by a couple of things. First of all, there was a shortage of lumber because a lot of mills were shut down during the pandemic. So there was just less production of cutting down trees and converting that into lumber planks. And as a result, there was a shortage. And that was in combination with a huge demand in home renovations and housing starts, houses being built. And the reason why that was happening was for a similar reason, right? People were restricted from going outside of the United States, for example. And as a result, they were looking for other things to spend their money on other than international travel. And one thing that people spend their money on when they don't travel is they renovate their home. They fix up parts of their house that they were planning on doing, you know, or they had planned on doing at some point in the future. Now is, you know, a good time to do it because you can't really leave the house. And as a result, you had this situation where not only did you have a reduction in the supply of lumber, but also a surge in demand. And the combination of those two things caused a massive increase in the price of lumber. So
it's kind of both sides of the equation hit the inflationary trigger.
Exactly right. And I mean, inflation can be driven from just one of those events happening, right? There would have been some increases in the price of lumber if demand was just normal and there was a reduction in supply, or if supply was normal, but all of a sudden there was a massive increase in demand. Any of those combination of those things could have created inflation, but the fact that both of them happened at the same time meant that there was such a dramatic increase in the price. But now what we're seeing through 2021 is that borders around the world are starting to open up, right? People are getting more relaxed, particularly in the US around COVID, as what now 70+% of the population has been vaccinated, or 65% or something like that. And I mean, if you combine the people who are vaccinated plus the people who have immunity from having the vaccine, you might be getting to 85-90% of the population in the US that may have immunity now. And as a result,
Right.
things are kind of changing. Market conditions, particularly for lumber, are changing. So renovations and housing starts has slowed down dramatically since the pandemic, as well as the fact that now we're a year later into the pandemic, the supply of lumber has had time to catch up with demand, right? Because what happens when there's a shortage and the price of lumber shoots up is there's more people who want to sell lumber because it's worth it, because there's a massive price tag attached to it. I mean, you could imagine maybe there were some businesses that didn't produce lumber because it cost them, I don't know, let's say $800 per 1,000 foot board to produce, and the price was $400, so they wouldn't produce it, but it shoots up to $1,600, and all of a sudden it makes sense for them to be producing that lumber. So that's kind of what's happened in terms of the supply side. And again, both of those two factors on both sides, demand has dropped, supply has increased, and the complete opposite effect has happened to lumber, which has really been dramatically seen over the past month, where the price of lumber has dropped a whopping 40% in a single month, which is massive.
Jeez.
Yeah.
And that would have so many impacts on what lumber is used for. I mean, 40%. I mean, actually, I don't know. Lumber mainly used for, I guess, building houses and construction and whatnot. I wonder how much. I don't know what percentage of cost of those buildings is in the lumber. Maybe it's not that high of a cost, but yeah. Either way, a 40% drop is very significant, and that's in 1 month. I mean, you think about that happening to some speculative stock and you're still surprised. 40% movement in 1 month. And this is just in the price of some commodity, some like raw material. That's pretty insane.
Yeah, exactly. And it's actually the biggest single month drop since 1978. So
wow.
It's been a very, very long time since there's been such a dramatic drop like that. And I think the important thing here is to understand, why does this matter? Like, you know what, I don't think myself and Brandon are going out and buying huge amounts of lumber. As you said, like maybe even if you're in the industry, I mean, I'm not sure. I mean, it kind of depends what industry you're in to what impact this would have on you. But why is it important for us as investors broadly? Why is it important to everybody? Well, the biggest question mark in financial markets right now, and I think you would probably agree with me, is what's going to happen with inflation. Is inflation just a temporary impact of supply chain issues, which is what the Federal Reserve is going with? They're saying it's just going to be, what's the word they're using? Transitory or something?
Yeah, transitory.
It's just going to be a short-term spike in inflation because there's been a lack of supply and an increase in demand for some products. But that supply is going to kick in and demand's going to drop back to normal and inflation's just going to disappear. Or there's people who believe that inflation is going to be a long-term impact, that all of this money printing, all of this stimulus that's being done by the government, which was necessary, but is happening regardless, that's going to have a continuous long-term push of demand in the markets and create long-term inflation. That's the biggest question right now in what is going to impact markets. So looking at something like lumber and seeing how that's changing can be a really good example of what we may see in other markets.
So I guess this is kind of this particular scenario is kind of leaning towards what the Federal Reserve was saying, how most of this inflation is going to be transitory, nothing to worry about. I guess this is an example of a commodity where it does seem to be like it's a transitory inflation because, we saw the big inflation as everybody got all the lumber mills got shut down and people started, renovating and buying, and that sent the price up a lot. And now it seems to have just reversed back, and we see a drop by 40%. So I don't know, maybe this is a case for what the Federal Reserve was saying, how it's just transitory. But I guess this is just this is just one commodity out of many. So interesting to see whether this continues to happen to other commodities as well.
Yeah, exactly. And I certainly the trend, at least over the past month, is a massive decline in the price of lumber as supply has kicked in and demand has dropped. The real question, I think, is kind of what continues to happen, because, of course, a 40% drop is dramatic. But I mean, if you're actually comparing the price of lumber to pre-COVID levels, they're still twice as high as they were against pre-COVID levels. So they have come back, but in order for there to be no inflation in lumber, or let's say 1 or 2% inflation in lumber, which would be normal, prices would still have to continue to drop dramatically. I mean, over the past 12 months, lumber still, after that drop, has 100% inflation, which is an insane figure, right? So, I think we just don't know yet. But certainly kind of what's happened with lumber, I think, is the beginning stages of what looks like lumber returning to normal. As supplies kicked in, but we will see. I mean, no one really knows until things play out, right? And
true.
This is kind of a lot of people are talking about this. A lot of people are using this as, I think, evidence on both sides, right? Like, this is evidence that it is transitory. It's going back to normal. Lumber, don't worry, guys. Lumber is going back to normal. And then you have people saying, yeah, but it's still 100% inflation, which is not small. And if we saw 100% inflation in other assets and other commodities, we would be losing our shirts. So we will see, I guess, what happens. As always, we have no idea. We can only look at what's happened in the recent past and that
is a good point. That is a good point, because that totally changes the story from what I was saying before, how it's transitory. It's like, hang on, it's still, so much, more expensive than what it was pre-COVID, that actually maybe it's not transitory. Maybe it just went insane and it's still pulling back a little bit, but it's still going to be very, very much inflated into the future. So I think you're right. We just have to kind of wait. We just have to continue to see what plays out.
Yeah.
I guess it would be interesting to see the other kind of raw materials, especially like steel, what happens with steel as well. Whether this same situation plays out in steel as, steel manufacturing ramps up. If there is a decline in home renovations or new home builds, then you could imagine that maybe that would impact steel a little bit, but I imagine steel's more for like big construction stuff. But I don't know. Yeah, interesting to see if maybe this happens to steel as well. I'm not sure.
Yeah, I mean, this plays in a little bit to what we were talking about last week when we were answering a question on inflation, and how it's very, very unlikely that inflation would happen evenly across everything, but more likely that if there was, say, a 4% overall inflation number, that 4% inflation number would be driven by higher levels of inflation in certain things. I think this could be, an example of how that may look, in that, the overall inflation figure could be 5%, but that doesn't mean that everything has gone up 5%. It could mean that lumber's up 200%. It could mean that steel is up this certain amount. It could mean that groceries are up 12%. And your wage has not gone up. And as a result, if you're buying a house, it's going to be more expensive because lumber prices have gone up. Or if you're buying groceries, it's going to be more expensive because your wage hasn't gone up relative to the price of fruit and vegetables, for example. So I think that's kind of what you should expect to see if this does play out. But we'll see. We'll have to keep watching what happens with lumber and then other commodities as well to kind of see how they change as we get back to more of normal behavior where people are spending money in a normal way and not holding back spending from things like travel, for example.
Yeah. All right. Should we move on?
Yes. Where should we go?
I wanted to talk about a little aircraft story, a little United Airlines story, because this one took me by surprise. Here's something you probably weren't expecting to hear, but United Airlines is going on a spending spree. They are splashing some cash, let me tell you.
Oh, no.
Which is kind of bizarre considering I thought their whole industry was like on the verge of bankruptcy. But anyway, oh, that's right. They got a massive bailout. Oh, they're fine.
Do they have to pay that money back to the government? No. That's right. No. They're doing share buybacks this year. Oh, cool. Okay, cool.
Yeah, exactly.
Oh, management compensation's up twice than it was last year. Oh, okay, cool.
Yeah, management compensation rises on the back of strong cash flows from the government.
Yeah. Who's paying for that? Oh, the middle class tax is going up. Okay, cool.
Oh, so
Nothing
true.
to see here. Nothing to see here.
Nothing to see. Anyway,
what's this story?
I need to focus. That was hilarious. Oh my golly gee. All right, sorry, back on track. United Airlines unveiled on Tuesday its largest ever aircraft order. 270 narrow-body jetliners from Boeing and Airbus as the carrier charts its post-pandemic growth. So what are they buying? They're buying 200 Boeing MAX jets, 150 are MAX 10s, which is the largest in the family. Then the remaining 50 are the remaining 50 Boeing planes are the manufacturer's most popular model, the MAX 8. United also plans to buy 70 Airbus 321 Neos, adding to an order for dozens of the long-range version of the plane.
Wow.
So, interestingly, if you just look at the sticker price of these planes, the sale is worth more than $30 billion at list prices. But airlines, and I didn't know this, but I guess it makes sense. Airlines, particularly for large orders, generally receive substantial discounts. United declined to disclose what it is spending on the aircraft. However, the order is likely closer to $15 billion, estimated Rob Morris, global head of consultancy at Ascend by Cirium, which appraises aircraft and provides a host of other industry data. So the fleet plan is central to United's goal of capturing more travelers, particularly high-paying ones in major coastal hubs like San Francisco and Newark, New Jersey. I've not heard of Newark. Have you?
No.
Anyway, we're just not from that part of the world. The MAX 10 and A321 Neo planes are the largest models in their families, and United will use them to grow in those markets which have capacity constraints, said Andrew Nokella, United's chief commercial officer.
Wow.
Also plans to expand in hubs like Denver and Chicago, and have annual system-wide growth of about 4 to 6% in the next few years.
Interesting.
So, not something that I would expect.
No.
But, I think that the main change in strategy here is that United are trying to do a little bit more of a Delta. And Delta are essentially they charge a little bit more, but they offer a much nicer experience.
Right.
So better quality seats, in-flight entertainment, yada, yada. So it seems as though United with these new jets are kind of going for that more, higher seat cost model, but we'll give you more. It'll be a little bit more of a luxury experience. They talk about, more seat rooms, seat back entertainment, that sort of thing.
Right.
Sorry, were you going to say something there?
No. All I was going to say was it's certainly an interesting move. I think there's probably not that many airlines that are going out and spending money on a bunch of new planes. And I mean, this was kind of something that Buffett spoke about as to why he didn't particularly, well, not this specifically, but one thing he didn't like about the airline industry is that a lot of money can get caught up in these bulky physical assets. And if there is a long-term decline in demand for flights, for example, let's say because people are doing less corporate travel because they're able to do more of their meetings online, these businesses can get stuck with a lot of their value stuck in these bulky physical assets that are difficult to sell. So it's certainly, I think, a very strong move by United to expand their fleet during this time. And if they can use that bigger fleet to capture a market where other airlines that are struggling are kind of just repairing themselves, or smaller airlines or airlines that have downsized during this process, then it could work out very well for them. It's kind of, you can kind of think of it as in Virgin Australia's situation where they went into administration, they were basically forced to downsize significantly their fleet. And as a result, they can do less flights. They can take less of the market, right? And that opens the door for something like Qantas to expand their fleet and almost permanently steal that market share if they can offer a better service at a similar rate and compete in that space. So interesting situation. I'll be honest, airlines and the flight industry is not an area I'm overly competent in. So it was surprising for you to say that they're buying maybe $15 to $30 billion worth of aircraft right after taking a massive bailout.
Pretty interesting. It says here the airline also announced a hiring spree that it expects to total about 25,000 employees for the new planes, including pilots, flight attendants, and mechanics. The article here from CNBC says, the order shows United's optimism about the recovery in air travel, which so far has been concentrated in domestic leisure flights. United said Monday it expects to post positive adjusted pre-tax income next month for the first time since January 2020. So, yeah, very interesting. I had a little bit of a dive because I'm still thinking to myself, man, these airliners they've been decimated. Yes, they got handed out like in total $54 billion between all of them from the government. But I'm like, these companies are still struggling so much. Like, where do they get at least $15 billion from? Because I just had a look at the most recent most recent quarterly report. And so United has currently $13 billion in cash or short-term investments. Long-term debt already sits at $26 billion. So I figure they're going to have to raise money. And I imagine this is how, big airline purchases, aircraft purchases are made anyways. They're going to raise capital somehow through most likely take on a big fat loan or something. But I figure to do something like this in the cash position that they're in is a bit of a risk. So I feel like they must definitely be seeing that the skies are clearing, I suppose, and business is returning to actually commit $15 billion to aircraft purchases. Or maybe they have some sort of agreement where this is a future. They won't have to pay this money for years or something like that into the future with the aircraft as they get built. Or I don't know how it's structured, but I mean, I hope maybe this is the beginning of the clearing. I looked back and Q4 operating cash flow for United was $63 million. However, in Q1, the cash flow was $447 million. So it's a substantial jump up. However, I did look back to their 2019 annual report, and from that, I gauged that they normally would do about $1.7 billion in operating cash flow per quarter. So still a ways to go, I think, if they're going to hit that pre-pandemic kind of stat.
Yeah. I mean,
yeah.
It's an interesting situation. You could probably make a pretty compelling argument against bailouts based on what this story you just presented, because the fact that they have $26 billion worth of long-term debt, and instead of raising capital or using their profits to start paying down that debt, they're continuing to expand. So they're by in no means looking to reduce the risk on their balance sheet and prepare for the potential of some other event that would prevent air travel in the future, maybe another wave. That's not out of the question. They are instead deciding to continue to push on forward at full force, because it's in all likelihood, if there is another wave, they'll probably get another bailout because they got one before. So you could kind of, I think you could make a pretty compelling argument that, I mean, there is a very good argument for bailouts, maintaining all of those jobs and not allowing an industry to be destroyed for an extended period of time, while other smaller aircrafts have to kind of build up to that level, and there would be higher fees for consumers for a long period of time. But yeah, there's certainly something to be said about businesses that know they will get a bailout if they fail, and how they conduct business. And they conduct business in a very different way than if there is a risk that, they will lose everything if they fail.
You're exactly right. Yeah, because like exactly what you said, once you've got one bailout, Oh, well, guess I'll get another one. Because, I mean, a bailout is essentially the government admitting that your business is too important to just let fail.
Yep.
So, I mean, if my business got a bailout, I'm sitting there going, oh, yeah, boy. Government doesn't want us fading out of existence. We could take as many risks as we want.
Yeah.
I guess that's kind of what banks did. And that was kind of like the global financial crisis. Like, the government's just going to save us, guys. This is awesome. I mean, a few banks obviously bit the dust, but, you know, for the big boys, a lot of them stayed. But, yeah, you're exactly right. When this is the classic story exactly that you touched on earlier as well over the past few years. Why would we bother to, you know, secure our balance sheet and reduce our debt? Let's just take all the money we're making and just give it back to our shareholders. And, you know, if we get into a tough spot, we'll just go knock on the door and ask little Trump over there, or now it's Biden, obviously, but it was Trump. And hey, excuse me, can we have a little bit of cash?
Hello.
All right, thank you. Yeah. A little bit. Can we have $54 billion? All right, cheers.
I mean, especially if you're an executive as well and you have not that much stock invested in the company. I mean, I haven't looked at the compensation packages for these airlines before the pandemic, but I would put my money, without even looking, that part of it would have been tied to total shareholder return, which is tied to how many buybacks and dividends you pay shareholders. Considering how much they were doing leading up to the pandemic, I would not be surprised if that was part of, and that's pretty common in these businesses. So for the executives, if they don't have much stock in the company, and they believe that the company will probably get bailed out, then it makes sense for them to take risk and, you know, go for glory, satisfy their compensation to the maximum so they earn as much as possible. And then if something bad happens, they'll get a bailout or they'll move on to another business, be an executive over there. So,
that'd just be the cherry on top, wouldn't it? All right, over to you, sir. Let's talk about Robinhood. What's going on with Robinhood?
Yeah, so Robinhood, which people haven't really spoken about Robinhood a lot recently, but over the last year, they've faced a lot of backlash for a number of different things. But this week, they actually got fined for some of those things. And I thought it would be an opportunity to kind of talk about something in regards to Robinhood, which is just kind of mind-blowing, because I had looked into this story before, and it's not really a new news story, but the specifics of what happened, I looked into today, and it's kind of mind-blowing. So I do want to talk about that. But the news this week is that they got fined $70 million US, and that was for a combination of outages, so the app being down and preventing people from trading either specific stocks or just broadly, and then also for misleading customers. So Robinhood is, of course, the brokerage-free trading app in the US that has over 31 million customers now. And they faced their biggest fine this week from regulators. And one of the biggest criticisms that has been happening for Robinhood is allowing investors to do two things. One is to borrow money, to allow kind of retail new investors to borrow money, and not having to really go through the loop, the steps that are usually required for you to borrow large amounts of money from a financial institution, and then also to be able to trade with complex financial instruments. So using things like options trading and risky types of options trading that allows you to invest small amounts of money and risk much bigger amounts of money, and giving that access to people who probably shouldn't be using those financial instruments. And I think overall, I mean, I'll ask you, maybe we can both reiterate our opinion on Robinhood, but I think my opinion is overall, I think providing more access to investing to more people is a really good thing. I think that more people should have access to what, you know, professionals have access to, and that you shouldn't have to go to somebody who's specifically done a finance degree, for example, in order to manage your money and to invest your money. I think overall that's a good thing, but at the same time, I think we have to be careful with like what access we're giving or a business is giving inexperienced investors to things in finance that are really complicated and can be extremely risky. Do you have any, what's your thoughts on that?
No, I would agree. I would say Robinhood should allow brokerage-free trading, and they should be open and honest how they make money to their users in being able to provide brokerage-free trading, because for the most people, they don't care. I mean, sure, selling order flow, whatever, it might make it a little bit more expensive, but that still wouldn't have a big impact to people. But yeah, I don't believe that Robinhood should freely allow margin loans, options trading. I think they should just kick that off their platform.
Yeah.
Just be a straight up, if you're going to be a brokerage site that has a reputation for being the go-to brokerage-free trading app for the masses, then just get rid of the margin stuff. Get rid of the debt side of things. Get rid of the options trading. And just don't even include it. But yeah, I don't know. Fine line, because obviously a lot of people would be like, oh, okay, I'm not going to use Robinhood now because it doesn't allow margin and it doesn't allow options trading. So fine line that they've got to draw, but I feel like that's just what they should have done. They just should have just kicked it. But anyway.
Yeah. I mean, I think an important thing to remember is when you go and try and get a mortgage from a bank, part of the reason why you have to provide your income and your assets and you might have to co-sign it with somebody else. The reason why you have to provide all of those things is partly because the bank wants to make sure that you will pay back the loan. But the other part is because they have a duty to make sure that you are in the financial position to take on a huge amount of debt. That you as an individual, you need to understand that there's a level of risk that comes with taking on a mortgage or taking out a huge amount of margin debt to trade stocks. And one example that the FINRA, which is the regulator, in their settlement with Robinhood, they cited this example that we've spoken about briefly before, but we didn't really go into the details of how crazy this story really is. But the story is about a 20-year-old kid or man, but I mean really a kid, who was using Robinhood, and within his Robinhood account, he had margin turned off. So you can go into your settings and turn off margin, meaning you're not trading on Robinhood's money. You're not borrowing money from Robinhood. In theory, if you turn margin off, you should believe, or it's fair to believe, that if you make trades and you lose money, you can only lose the money that you put in, right?
I'd believe that.
That would kind of make sense, right? Unfortunately, that's not actually true. Well, maybe it is now, but previously with Robinhood, even if you have margin turned off, if you made certain trades that required margin, it could automatically rack up a margin loan with Robinhood. And one of the ways you can do this by accident is when you're trading stock options. And a lot of stock options they're risky trades, but they're not limitless trades. But there are ways that you can trade with stock options that are incredibly technical, very difficult to understand. It kind of makes sense that people probably shouldn't have access to these. But we don't actually know what kind of trades this person was doing, but this Forbes article went through and based on the information we do have, we kind of have an idea of what likely trades he was doing. And what he was likely doing was what are called bull put spreads. And I don't want to get too technical because, I mean, honestly, like I barely understand how this works.
That doesn't sound like something I want to put on my toast, bull put spreads.
Yeah, I mean, it's very complicated. I'll give you a top level understanding, and the Forbes article goes quite in detail into explaining how it works. So I recommend you check out the Forbes article on bull put spreads after this if you're interested. But it basically means you're buying and selling put options at the same time. So a put option at a very top level is basically a contract that gives you the right, but not the obligation to sell a stock at a set price. So it's basically a contract. And you're going to, and doing this kind of trade is selling and buying them at the same time at different prices. And the trade has a pretty small maximum loss if the stock price ends outside of the two prices. So say one contract has a price of 100, one has 110. If the stock price ends outside of 100 and 110, then the loss or the gain is kind of pretty small. But if the stock finishes between the two contracts, then the loss still is limited, but something really, really weird happens. And what happens is you're forced to buy the stock under one of the contracts, and you wouldn't be able to sell the stock that you've bought until a few days later. And you might not
Okay.
have the money to do that, right? So you're going to have to go into debt to buy those shares, wait a few days, and then sell them.
Right.
And
So that happened to this guy, did it?
pretty much. And again,
Yeah.
I don't expect most people to understand like what I just said. I barely understand what happened, but let me just give you an example of what could happen and how you could accidentally fall into doing this. You could do this trade with just 3 contracts of Amazon stock, and to do that, you'd probably
Okay.
need about $1,000, about $1,000 or $2,000, right? Which of course you could borrow from Robinhood if you had no income. So you basically need no money. And then immediately as you do the buy and sell contract, you would get money back. So you would actually be out no money. Or you might even have a little bit of a positive account as soon as you did this trade, maybe by a few dollars. If the stock finished within the strike price of the 2 contracts, your balance on those 3 contracts of Amazon stock would be negative $800,000 for 3 days.
Whoa. Ay, ay, ay. What the heck?
Yeah. And that doesn't mean you're down nearly $1 million. It just means that your account is negative for the 3 days until you can settle it. But
Right.
the crazy thing is, I don't expect the vast majority of people who are just trading stocks on Robinhood with a few $1,000s to understand that having an account that is negative $800,000 doesn't mean you're down that much. And the tragic thing, the reason why this story was given as an example while Robinhood was getting this fine was that this 20-year-old saw this account balance and then took his own life because he didn't understand what he had done. He didn't understand that he actually wasn't down that much money. Now, he was down a lot of money in his account, but he wasn't
Right.
down that much. And I think that's just a really good example of why some of these instruments should not be accessible to the average person. It's kind of crazy, right? That you could do
Yeah.
a trade with 3 contracts of Amazon stock and be down almost $1 million. Not actually down $1 million, but that's what your account would look like for a period of time.
And that's the thing, clearly, is that if people don't like, I don't really get it, but if you saw that pop up in your account and you didn't really get what you were doing, you would just, it's not about what it actually is. Like, you're not actually down that amount.
Yeah.
But if you just saw that happen, and you see negative 800,000, you're like, what? I was just messing around with $2,000 of Amazon stock. And then you see negative 800,000. That would freak me out. I mean, if I just logged onto anything and I saw a negative 800,000, immediately my heart would skip a beat. I'd be like, what?
Yeah, I mean, of course you would be. And I mean, this is kind of like a bit of the dark side of giving access to investing to a lot of people, because I mean, especially now with the internet, you have people who are selling options courses left, right, and center, and teaching novice investors how to trade these complex instruments. And you would have a lot of people who are kind of just copy and pasting trades and not really thinking about it. Oh yeah, okay, 3 contracts of Amazon. I got to buy this and sell this on Robinhood. I do it with brokerage free. I take a little bit of debt from Robinhood and pay it back immediately, and I'm all good. And then this happens and you have no idea why.
Yeah.
So yeah, it's kind of strange, but yeah, they got fined $70 million.
Copping a fine.
And
Copping a fine. Wow.
yeah, I mean, the other thing in this story, I didn't include it here, but they also have had a history. I think over 120,000 people have had the wrong balance showed in their account. So not only could you have the correct balance shown, and you know that freak you out, but people have had the wrong balance shown. So it's shown that they were down more than they actually were, which is incredibly dangerous. To incorrectly show someone's balance. So yeah, I mean, Robinhood, they're doing a good thing, I think, but it's they've got a lot of things they got to fix. They
need to tighten it up.
Yeah, they need to tighten the screws. They need to,
Yeah, absolutely.
yeah.
Oh dear. Still, imagine if you got the opposite. Imagine if Robinhood incorrectly displayed your account balance as like $1 million.
Withdraw.
You'd be like, withdraw. Yeah. I'd be on the phone, customer support right away. Excuse me, I need to immediately withdraw my funds. Can you please deposit them into my bank account?
Take a quick screenshot immediately. Look, I had the money.
Yeah, shut down your account immediately. Leave the country. They can't chase you. Oh my golly gee. Yeah, obviously Robinhood really needs to tighten up its act. Really has to tighten it up. All right. I just wanted to fly through this. This is kind of interesting. There's not much to this story, so we can get through it quite quickly. It says here, Facebook is testing drastic changes to Instagram to make it more like TikTok. So it says Facebook's head of Instagram on Wednesday announced the social network plans to start showing users full screen recommended videos in their feeds. Quote, we're also going to be experimenting with how do we embrace video more broadly, full screen, immersive, entertaining, mobile first video, end quote, Masseri said in a video posted on Wednesday. You'll see us do a number of things or experiment with a number of things in this space over the coming months. So specifically, Masseri said Instagram has plans to show users full screen videos in their feeds. This includes videos it recommends to users, including those from accounts they do not already follow. Users will start to see Instagram's experiments with these changes over the coming months. So I guess this is interesting because, I mean, that's about all there is for this story. There's really not much to it. They're going to start showing us full screen video content. But what I thought was interesting about this story is the strategy that you see. And you do notice this with businesses all around the world. Pretty much the strategy is that when smaller businesses successfully break the mold and become very popular, the big businesses simply copy the features of the small business. And from a business perspective, that isn't lazy. That's incredibly smart. For example, in this case, Facebook knows that they have the most users across their app family. Like, no one's even coming close in terms of social media to Facebook. They are number one. They are the big behemoth. Everyone else, they're tiny compared to Facebook. So Facebook doesn't need to be first with these different app features. They don't have to be that at all. They can just keep providing what they're providing, and they've got so many users that they just don't care. But what they do have to look at is what features become popular on other apps and then simply add the functionality in after the fact. So a good example, the first example I remember of this is Stories, because originally Snapchat, that was their breakthrough. Stories was Snapchat's breakthrough. And now every app has a Stories functionality. So I thought this is a bit of a story, non-story. It's like, oh, great, TikTok features are going to come to Facebook. But I think it's an interesting example of what happens in business. I guess it's the copycat strategy, and how easily that can be implemented for when a business is just so far ahead, like a Facebook.
Yeah. It's the other thing that I've noticed from this is it's really interesting to see the shift in what people want from social media. And it seems like it's pushing more towards really fast content. So even shifting towards things like Stories, for example, where people don't even want to post a photo where it's permanently on their page. They just post it for 24 hours, right? And it's just really fast. You can just flick through and see what people are doing on that particular day. To now TikTok, where you have, these 10-second videos and people just swipe through. But the other thing that's interesting is people seem to be quite happy for an algorithm to serve them up what they want to watch, right? On one end of the extreme, you have something like YouTube, where most videos or most views, and I'm sure it's the same for you, most of the views come from people just clicking stuff on the homepage. So it's just recommended. It's just Google recommending. But even on YouTube, like if you open the homepage of YouTube, you have a lot of options, right? You can manually search immediately. There's maybe like 8 to 12 options for recommendations, or you can go into your sub box. On the other end of the extreme, you have something like TikTok, where you open the app, it's just one feed, and you can search, but basically you open it up, it's one feed, it shows you one video, and you flick, and they recommend you another one, and you flick, and they recommend you another one. And that seems...
all algorithms.
Exactly, and it's just purely algorithmic. How long do you stay on the video? Do you like it? Do you engage? Do you flick past it immediately? And it's basically from that, they can build a very, very simple algorithm, but powerful algorithm that shows you exactly what you want to see. And it seems like that's the direction that Instagram wants to go as well, that they want to kind of convert their app into that kind of way, where people have, instead of flicking through the feed and looking at a lot of different choices, they're just one by one going through what is recommended to them.
Yeah. I don't know if you remember back when YouTube first introduced the recommended tab.
Yeah.
Do you remember that?
Yeah, I do.
There was such an
People
outcry
hated it.
because originally there was no recommended. Your homepage was essentially your subscriptions box. So you would only see the videos that have been uploaded by your, the people you've subscribed to. And then they introduced this algorithmic feature of the homepage would no longer have a sub box, but it would have recommended videos.
Yeah.
And at the time, we're all like, what? This is going to destroy us. This is going to be the end because people have to take the extra second to click on subscriptions and people aren't going to be watching our videos anymore, that our subscribers won't see our videos, and we were getting so annoyed. But now it's just the number one way. Like, I don't know about you, but my YouTube experience is pretty much all the videos I click on are from recommended.
Oh, yeah.
And of course, like, you get recommended videos from the people you've subscribed to. But it's so interesting now. It's such a powerful tool. The algorithms have gotten so good that recommended is just a beast. And nobody complains about recommended now.
No.
Nobody. It's just so powerful. Like, all of our views come from recommended.
Yeah, I mean, the same thing was the case when Facebook switched their feed from chronological to algorithmic, and the same thing with Instagram. I mean, immediately everyone kicked up a fuss, like, it's so good that it's in order. But I mean, it's better for Facebook and Instagram to have algorithmic, so they can keep you on the platform by showing you things you're more likely going to see. And it actually makes it better. Zuckerberg made an interesting argument for algorithmic sorted feeds, and that it was that a lot of, when they were chronological, you just had a lot of people just spamming posts because they knew that as soon as they posted, it would go to the top of the feed. Whereas you can't even do that anymore because you can't just post something and it goes to the top of the feed. That doesn't happen anymore. If you're being spammy, the algorithm won't show those things. So it is interesting how this has kind of evolved, and what we're kind of not only have accepted, but are actually what we actually prefer now. As seen by our choices in certain apps. I don't know. We'll kind of just see how this will be another battle, where I think when Snapchat introduced their features of story and Instagram copied it, I think most people immediately thought that Instagram would fail at that, but I think they've clearly succeeded in a massive way. So whether the same thing will happen with TikTok and their Reels feature, I don't know. We'll just have to kind of see who wins that battle. But
Instagram has Reels, so
I wouldn't count out Instagram, I think, on that, because people really like when everything is all in one place. And I think that is why stories did so well on Instagram, was you were already using Instagram. The addition of Snapchat didn't mean you were not going to use Instagram, because Snapchat didn't have your entire friends and family list and your entire history of photo sharing on the internet, basically. So you weren't going to substitute Snapchat or Snapchat for Instagram. So by introducing those features, Instagram was able to win that battle, I think. And maybe the same thing is true for TikTok. I don't know. TikTok's way bigger than Snapchat was already. So it's going to be a lot more competitive, I think. But we will see.
Yeah. But an interesting example of copycat business, which we see a lot. I mean, Apple's a classic example.
Oh, yeah.
Apple, they weren't the first to wireless headphones, but they saw that it was a trend. It was picking up pace. They released their own product, and what do you know? Everyone was starting to buy Fitbits and Garmins, those watches that tracked all your activity. Apple sees the popularity. They, come out with the Apple Watch. Plus the added features of being able to connect with your phone in that Apple ecosystem. Bang, it's a genius product. So, it's interesting in business. You don't have to be first.
Yeah.
You don't have to be first, which is interesting. I mean, you don't have to be first if you're a big business, because a big business can. If you're a small business and you're second, then it's quite hard because everybody's already gone with the first option.
Yeah.
But as a big business, you really don't have to be first.
Yeah.
All right, should we do just maybe like one or two Q&A questions
Yeah.
just to round us out for this week's episode?
Yeah, I'll read this one to you. We'll get through a couple, and as always, if you have more questions, feel free to head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and leave your questions as a comment there. And each week we do our best to get through as many as possible. So I'll read this one to you. Hey guys, love the podcast. Phil Town's rule number one is my new Bible. Learned more from that $20 book than a financial degree. There you go. Just wondering, are you using the 3 technical tools, the MACD, the stochastics, and the moving average, to monitor your index funds? And the other question is, does it make sense to move to cash when there is a clear COVID-like drop coming? Cheers.
Yes, I think we've answered the indicators question before, but I don't really use them very often at all. I'm much more just like look for margin of safety. However, this person does say not about individual stocks, but more for index funds. And no, I don't use the indicators for index funds, because I think if you're using the indicators for index funds and you're dollar cost averaging, the only thing that the indicators are going to do is scare you out of making an investment, when really that's not what dollar cost averaging is about. You want to be showing up at your predetermined time intervals and you just want to keep investing. You don't want anything to try and persuade you not to invest, if that makes sense. And then on the second question, does it make sense to move to cash when there's a clear COVID-like drop? Well, I mean, in hindsight, then I would say definitely it makes sense to move to cash. But I think the example with COVID is like, who knew that was coming, and who knew what sort of impact it was going to have? And even if you thought that the stock market was going to go down and you managed to time the market and you definitely got that right, I mean, how do you know, like, where's the bottom? It's hard to know, because obviously you don't want to be out of the market. That's not your ideal scenario. Your ideal scenario is you want to be in the market, because that's where we make our money, right? So it's like if you've pulled all your money out of the market, then when do you get back in? So I personally, I just think trying to time the market is just it's just impossible. So I just don't do it. So even if you feel like there was probably a case to be made back when we saw coronavirus come, and especially when it hit the US, then we're like, oh, here we go, this is going to get nasty. But I didn't at that time feel the need to sell my stocks, because I just wasn't sure. I mean, we're probably thinking, yeah, the stock market's definitely going to feel the impacts of this coronavirus thing, but we didn't know that. And I think because it's just so unpredictable, timing the market is just not. I mean, you're just unlikely to make money from trying to time the market. I think it's just too hard.
Yeah,
what do you think?
It's very difficult for people to sell out of stocks before they start falling. And I think most of the people that I heard that have the strategy of let's get out before this crash happens were selling after the majority of the 30% crash had happened, because you have to wait for some level of the market coming down, right? Otherwise, well, I mean, it's just overall, it's very, very difficult to maybe difficult or maybe even impossible to predict when you should be timing the market. But I think with that said, you can see your portfolio go into larger amounts of cash just by the lack of investment opportunities. And I don't think that's the same thing as timing the market. I'm not selling out of stocks because I think there's a crash coming, or I'm not buying into stocks because I think it's the bottom of the market. But I look at individual stock opportunities, and if there's no good investments available to me that I'm really confident on, then of course my cash pile will slowly be building up over time. Yeah. And when there's a lot of opportunities and when there's, blood in the streets or whatever, I'll be deploying a lot of cash and my cash pile will be naturally going down. And that's not timing the market. That's just taking the opportunities that are available. And
it's just a function of the strategy.
Exactly right. So I think those two things should be distinguished. But in terms of the technical tools, I don't use them at all. I don't think Phil Town uses them at all. I'm pretty sure he said that he doesn't use them to trade in and out of stocks, and especially, as you said, on index funds. The purpose is to mimic the market, to copy the market, not to try and beat the market by trading in and out of it.
Yeah. Yeah, I agree. Should we wrap things up there?
Yeah, for sure. Thanks everyone for tuning in. As always, it was another jam-packed episode of the Young Investors
big,
podcast.
wasn't it?
I hope you guys enjoyed some of the stories we went through today. And if you have any news topics throughout the week that you hear of that you would like us to cover, or anything at all, questions, anything at all, then make sure you head over to the YouTube version of the podcast, click on the latest episode, and leave us your topics or questions there. youtube.com/The Young Investors Podcast. Thanks again, ShareSite, for sponsoring this episode of the podcast. Again, if you want to get 4 months off a yearly subscription, or just want to sign up to the free plan and use it forever, then head over to sharesite.com/young investors. That's site spelled SIGHT, sharesite.com/young investors. Thanks, Brandon, for joining me as always. And we'll be back next week for episode 136 next week. We're getting through them.
Woohoo! Yeah,
Coming up on 150, actually. So
soon. Yeah.
we'll have to
not too far.
Not too far away. Anyway, see you later, guys. Have a good week.
See ya.